Welcome everybody. Good afternoon. Thanks for joining us today. Special thanks to you, Charlie, for joining us again for our installment of going through some charts and current events with you.
Absolutely. Good to be here, Caleb.
Yeah, can't wait. Well, let's jump in here. A couple housekeeping items to kick things off. Um, First of all, please keep in mind that nothing we say here is investing advice. Hopefully you get some good ideas from us, but don't construe it with actual investment advice. Also, replay will be available on YouTube. And if you like our content, please don't forget to hit like, punch the subscribe button there on YouTube so you get all of the YCharts content sent to you right away. But yeah, super excited to have Charlie on. For anybody new to this series, we sync up with Charlie at least once a quarter just to kind of get your thoughts on what's been happening in the economy and some great takes on not only the trends but also some amazing visuals that you can always come up with to help capture those trends and some great voiceover. So looking forward to doing that again today. We do have a little bit of a different agenda this time than we did probably for the last couple of times we got together, Charlie. And what we're going to do is we're going to go through a number of charts that actually are part of a deck that we publish at YCharts and update every quarter. It's called our Supercharged Asset Gathering deck. And it is a collection of a lot of the most common visuals that we see the advisors, the financial advisors that use YCharts, kind of asking to have updated and asking to be published to really help their conversations with new prospects or clients to talk about investing and talk about the markets. So we thought it'd be great, since we've just updated this deck again for the most recent quarter, to get your take, Charlie, on how you would talk through these charts, right? I mean, that's the whole idea. The chart tells a story, but the voice behind it and actually coordinating that conversation is another big part. So would love to have you talk through these. And then, of course, we'll touch on current trends and topics as we get into some of the charts at the end. Sound okay?
Awesome. Let's do it.
All right, well, let's jump in. So first section, ups and downs, but usually more ups. And our first chart here looks at historic bull and bear markets. And I think the kind of talking point here is, markets can be volatile, but usually the good outweighs the bad. But how would you talk about this, and how would you tie it into kind of what's been going on recently too?
Yeah, so as an investor, you're expecting ups and downs, but you got to put that kind of in perspective. How long are the ups? How long are the downs in average? And the natural trend of the market, thankfully, Caleb, is up, right? The market goes up over time, most of the time, because most of the time the economy isn't in expansion. Most of the time earnings are growing. Most of the time things are getting incrementally better. But every so often there's a scare, and we call those bear markets. And thankfully, they tend to be shorter in duration, and they don't wipe out all of the gains from the bull market. So we have a lot of different data points here, but I think the big one to remember: bull markets tend to last longer, I think around 5 years on average. Bear markets tend to be short but painful. There's a lot of variability in how long they can last, but the average is around a year. Last year, of course, we had one that took about a quarter of the S&P down, about 25% decline, and you have to expect that. It happens once every 4 years on average, that type of bear markets. But you could go long periods of time, as you can see here, without having a bear market, or you can have a few in a very short period of time. There's kind of no rhyme or reason to it. But the lesson for investors really is that bear markets are a part of investing. You have to expect them. You should be expecting them. If you haven't had one, it's only a matter of time before it's coming. But thankfully, the gains on the upside outweigh those losses on the downside.
And I think the natural next question is, can we stay out of those bear markets, right? Wouldn't it be great to avoid those losses? But this next visual, I think, preaches the opposite message, which is stay invested and stay invested for the long run. But talk to this one too, and tell me what big elements you pull out.
Yeah. So the way I like to think about this type of thing is thinking about a casino. I don't know if you're a gambler, Caleb. Do you like going to casinos?
Every now and then, every now and then.
Every now, okay. So me, not so much. I don't like going to casinos because I don't like losing money. And there, you have almost guaranteed to lose money if you stay there long enough. And the longer you stay, the more likely you are to lose. In the stock market, it actually works in the exact opposite fashion. If you're looking at daily returns, it's pretty much a coin flip. S&P 500's up a little bit more than half the time if you're looking at the average trading day. If you extend that to a year, it's about 3 out of every 4 years the S&P is positive. When you extend it out to 10 years, it's over 90%. You get to 20 years, there's never been a 20-year period where the S&P 500 has ended lower than where it started, and that includes the Great Depression, as we'll talk about later. But if you're looking at this chart here, the important thing I think to note is how time is your best friend as an investor. So the advantage that the individual investor has over professionals like hedge fund managers who are trying to really trade every move and they're trying to produce a monthly return and oftentimes not successful in even in trying to do that. You don't have to play that game as an individual investor. You can think longer term, and the longer term you think, the higher your odds are of having a positive outcome. So if we look at that top chart there, the top part of that chart, we're looking at 20-year annualized returns. You can see all of them are positive. So the worst 20-year annualized return, 2% per year. And these are price returns, Caleb. So important for everyone to remember, if you add on dividends, you're going to have 2 to 3% higher per year than that. But the important point is it's positive in all periods. If we go down to the 10-year returns, average returns below it, you can see the worst returns down 5% per year, right? And if we look at 5-year annualized returns, the worst return negative 8%, and so on and so forth. If we look at 3-month variability, you have a 30% decline looking at that 87 crash, right? And so I think the lesson should be clear here. You might get the short term right, but you shouldn't be betting on that as an investor. The biggest gains are going to come from those compounding those long term returns, and put the odds in your favor by playing really the long game instead of focusing on the short term.
So time staying in the market makes sense. I think one of the most common debates about where to be in the market is value versus growth. And, what was it, maybe a year ago, I think everybody was excited about value again. It seems like maybe that trend has once again kind of shifted back towards growth leading the way. But how do you think about the challenge of choosing value versus growth, or choosing neither and just choosing the index? But
Yeah, so most investors, they'd probably be better off not chasing one of these two because they're likely to chase it after the fact. And so what we can see here in that bottom panel is very clearly that there's been periods where growth has outperformed value above that zero line, and periods where value has outperformed growth below that. And these cycles can last for a really long time, which can be very challenging if you're trying to pick a change in trend. You and I started talking about this, Caleb. I don't know if you remember. I think it was back in early 2021 when growth versus value was at the highest levels it had been since 2000. And we were saying at the time, well, that looks really stretched. That looks like something where you probably shouldn't be pressing the bet if you've been benefiting from that, and maybe even start diversifying in the other direction, thinking about value. And a year later, if we look at last year, that looked like an awesome kind of call to make because value really outperformed growth last year. We saw all of the big tech names have a huge sell-off, but lo and behold, this year we saw the reversal of that trend, and you had things like AI and the Magnificent Seven, as they're now calling it, reverse and lead the market to the upside. So growth has outperformed value. And what the average investor should be realizing by this is that it's impossible to time these things. And if anything you're going to do, leaning one way or another, it really should be leaning only when things get to an extreme. And I would say still today, we're in an extreme where growth, if we look at relative valuations, even within value is cheap, even relative to its historical valuation. But there shouldn't be any expectation that's going to work next year or the year after. You're looking at maybe the next decade, you have a higher probability, I would say, of this mean reverting a little bit. But the average investor, if they want to ignore this altogether, if you're in a broad total market index fund. You're going to have growth. You're going to have value. You don't have to play that game. If you're somebody who's going to be succumbing to that chasing game, then probably stay out of it altogether. If you think you can be somewhat responsible and kind of lean or tilt in the direction when there's one extreme or another, and perhaps that can be beneficial. And today is no different than back, I would say, very similar back in 2000. It's very hard to go in that other direction because we have that enormously long period of leadership from growth, and it's all the names you know, right? Apple, Amazon, Google, Microsoft. We talked about this a million times, but it's very hard to bet against those companies inherently. And so for the average investor, probably don't play this game. But if you're someone who's a value investor, you're long-term oriented, you don't care what's going to happen in the next few months, perhaps you consider tilting a little bit towards value.
Nice. Also, probably another opportunity to note that over the long term, they're still both positive and strongly positive. So choosing a strategy and sticking with it, is still going to pay over the long run. Jumping into the next section here, though, right? Staying for the long run, speaking of the long run, I think this chart is always relevant, especially relevant when there's just so much going on in the world, but really kind of neat visual just to say there's always a reason to sell. And I think the point of this chart is when you sit down with an investor, or if you're an investor yourself and thinking, should I get out of the market? There's so much bad news. How do you think about this, Charlie?
First, I wouldn't try to dismiss it altogether and talk to you somewhat, because sometimes there's a reason, pretty good reason to sell, and the market, as we saw, can have long bear markets. And so in March 2000, you had stocks go down until October 2002, and they were cut in half. After October 2007, similar thing, they went down until March 2009, and they were cut in half. The problem, of course, with the reasons to sell and selling because of a reason is you don't often then have a reason to get back in. It's until things recover and until the news gets better. So usually the reasons to sell are coming after selling has already occurred and after you have a big decline. So if we look at March 2020, there was a lot of reasons to sell, right? We were about to shut down the entire economy in April 2020, but we already had the stock market down 35%. So you had to say that things were going to get worse from there. And they could have, they just didn't. We know now, looking back, we did this massive stimulus from the Federal Reserve, federal government. A lot of things can happen that you're not anticipating. So it's kind of remarkable, though, Caleb, looking back to 1989 here, that S&P's returned 10% per year total return with dividends, despite all of these really terrible things that are happening, which is kind of the lesson here, is that there's, even despite all of this bad news, there's incremental progress. And ultimately, stocks go up over long periods of time because earnings tend to grow over long periods of time, and things tend to get better over long periods of time. The hard part is in the short run, and this is what dominates the news cycle, of course. What gets all of the attention is the bad news, which can happen very quickly, and it could wipe out years worth of gains in a very short period of time.
Just want to really quickly touch on, we've seen a couple of questions come in asking about these charts. These charts are something that we make available. I think we'll send them out to people as well. So just wanted to make sure that everybody knew that. Jumping into the next slide here, though, another question that's come through a couple of times is we've talked, for the last 10 minutes or so already, primarily about stocks. There are other asset classes, though, and some of those other asset classes may be harder to defend being in, especially when you look at just the long-term power of the markets and staying invested. So I think there's a few messages here. One is just how impressive it is to look at the gains in stock indices over huge periods of time. But also, how do you think about talking about the other asset classes and why it makes sense to have those in your portfolio as well?
Yeah. So if you look at the S&P at the top there, everyone should be asking, first of all, well, why is it on top, and how do I get that, and what's the reason for that? And it's really, the reason is the chart that we just showed, right? All of those reasons to sell, all of that bad news that you have to absorb as a stock market investor is creating this premium that you get above quote unquote safer investments, right? So there's no free lunch. The reason why you're getting that higher return in the stock market is because there's higher levels of risk. And so that 10% return is coming because there's a chance you can have a bear market that's going to, at any point in time, wipe out 20, 30, 40, 50% of your gains. And yes, in the long run, it will come back. But that fact, that possibility that can occur is leading to this premium above safer investments like cash or even bonds. But I think your question is, why should anyone own anything other than stocks? Well, the answer is because the stock market doesn't always go up. And when it's not going up, you need these other investments to kind of balance it out and keep you invested. And also the other thing, of course, is not everyone has a 30-year time horizon. And the shorter your time horizon, the less ability you have to withstand those drawdowns in the stock market that are inevitable and that you can't really time. So for all those reasons, diversifying away from just stocks tends to be a good idea over the long run. And what you'll see here is also there's a premium not only within stocks over bonds, but within bonds, taking, and this has been the opposite lately, but longer term bonds tend to outperform shorter term bonds over very long periods of time. But that is not permanent, right? You can, in the past few years, we've seen the exact opposite, where longer term bonds have gotten killed because interest rates are rising and shorter term bonds have done very well, right? But I think the most important thing on this chart, Caleb, and the real reason why you have to invest over the long term is to really preserve your purchasing power. And if we look at that inflation growth per year, 2.7% per year since 1989. But if we're looking in recent years, it's been much higher, right? The past few years, we're looking at almost 5% inflation per year. And over the last 100 years, and I don't have any reason to believe the next 100 won't be the same, the stock market has been the single best preservation of your wealth in terms of not only keeping up with inflation, but outpacing it. And that's hopefully going to be true going forward. I don't have any reason to believe that it won't be. Maybe returns won't be as high going forward as they have in the past, but you have to invest, because otherwise, if your cash is just sitting under your mattress, there's going to be inflation. And if we look at we're not going to touch on it today, but if we look at the amount of national debt and the way it's growing pretty rapidly, to say the least, I think it's a safe bet that there's going to be continued inflation in the years to come.
And we'll get into the bond market a little bit more and some of those inflation statistics too in a later section. But I do want to jog back to kind of this concept of trying to avoid some of those sell-offs or selling when there's bad news. This chart kind of shows common mistakes investors make when they actually do sell. And even if they get back in the market or if they don't get back in the market, the impact of making that decision. What are your thoughts on if you're going to sell, like how to get back in, or how to think about making that decision when you do decide maybe it is time to move out of the market a little bit?
Well, yeah, this is showing you kind of the worst timing possible, and that's good to show because there are people who did this, right? Who sold
Well,
at the
it's
bottom.
common, right? You kind of have that capitulation moment when the market's at its all-time
You're
worst.
going to be much more likely to do it then, right? And if you do it on the belief that I could just wait a year, like things were certainly much better a year after the financial crisis. The news was much better. You probably got a much better feeling. The problem was the market had run up a huge amount between the bottom and that point, and that alone is costing you a few percent per year in terms of return. And that's assuming you got back in after a year. If we can see, if you didn't get back in, and there's certainly people in this camp, well, now they missed out on the whole bull market, and it just becomes harder and harder to get back in. Obviously, the higher and higher it goes, if the reason that you were selling is because you thought it was going to go most likely lower from that point, and then to psychologically reverse that and say I'm going to get back in, that's the hardest part about it. So I think if you're going to try if you're worried about the market going down, and that's not it's not an invalid fear to have, right? We just showed the market's going to go down many times. If you're a long-term investor, you're going to have these types of declines. The best way to prepare for that is in advance and figure out the amount that you could stomach in terms of that downside, and then hold that amount in equities and the rest put into things that are safer and aren't going to fluctuate. The good news today is you have cash paying you 5.5%, right? So this is something very different than 2 years ago when everyone was saying cash is trash, and there was 0% yield, and now you get 5.5%. Not too bad for doing nothing. So the opportunity cost of that's not to say that you should get out and sell everything. You certainly shouldn't, right? We're still, if the market returns 10% a year, it's still better than cash, and that cash rate is not permanent by any means, right? If the Fed starts cutting rates next month, or they cut rates back to zero, well, now you're not earning anything on that once again. But it's to say that strike a balance in your portfolio, invest the amount that you can withstand the short-term risk, and the rest put in areas that are going to help you sleep at night. So I think there's a general aversion to cash for good reason for a long period of time because it was earning nothing. But that sleep at night premium to me is very important, and it's part of that overall plan of how do you stick with something that's so inherently volatile as a stock market. Well, it's by having enough cash to withstand that, so you don't have to touch stocks at the bottom in 2008, right? So we're not talking, we haven't discussed here what was going on at that 2008 financial crisis. People were losing their jobs, right? And so some of them, they had to sell, and they needed the money, right, for a variety of reasons, right? And so it's just yet another reason to balance your portfolio between long-term reward, but also having enough in the short term that you could withstand the short-term risk.
And we've got another chart right after this one that kind of talks about the same phenomena, but in a much more recent experience. Maybe we can use this though. That I've heard the advice, if you do make the decision to move to cash, to at least have a plan to get back in, whether that be dollar cost average back in over time, or have points where you're going to get back in the market, whether it goes up or down, to make sure that you get back in. Do you believe in that kind of strategy?
No, I don't. I don't believe it. I think prepare in advance. So if you're worried about the market going down, lower your exposure to the stock market, and then instead of having the urge to get out, you'll be thinking about deploying that cash that you raised in advance, right? So you want to be a buyer on weakness. For every tick lower, the market's long-term risk reward improves. And we'll talk about this on the last slide today, but a year ago today was very different, right, than today. And the only way to take advantage of that type of decline we saw last year and the fear that was going on was to have that balance in your portfolio and have money to so I just don't think it's realistic, Caleb, for the average person to say I'm going to get out after during a bear market, and they're going to be disciplined enough to try to get back in, because if they don't time it exactly right, let's look at the two scenarios right from there. So the market goes lower from there, the news is going to get worse. So they got out because things were bad, and things are getting worse. What's the likelihood they're going to get back in if things are even worse? I would say probably very low, if the
Pretty
reason
low.
that they sold. And then if it goes the other way, starts going up, well, now they're going to be forced to say, "Gosh, I missed out on that. I'm going to hope it comes back down again." So
Yep.
very hard. Don't advise that for most people. If you get lucky and you get out and the market goes down, count yourself as lucky and get back in.
Back in. No, I'm really glad you answered that question the way you did, because I think it sets up our next chart perfectly, which talks about how impactful it can be to miss the few best days in the market, which just so happen to often happen during a bear market, or after one of those big kind of sell-off moments, right?
Yes. So unfortunately, no one rings a bell at the bottom or the top. And it's particularly important at the bottom, because what we tend to see historically is the market doesn't kind of just meander back up. it tends to move up in a violent fashion. As soon as that uncertainty is taken away, the market's looking forward, right? So if we look at the lows in March 2009, again, if you just look at the path higher, it was extreme, Caleb, and the news was terrible then. We were getting earnings reports that were absolutely horrendous. It seemed like, what is going on here? Why should the market be rallying like this? But it was looking ahead, right, to the recession ending, like that June, a new expansion began. It was looking ahead. We didn't know that at the time, right? But it was looking ahead and missing out on even that little portion there. It seems little, but market shut up 40% in a very short period of time. So missing out on those few things are going to cost you a huge thing, as your chart here illustrates. We don't know when those 10 best days are going to be in advance. So you have to you have to be very careful during bear markets and thinking, well, because the opposite, we're not showing it here, is, well, if I just avoid the 10 worst days, then I'll be much better off. And yes, that's true, but that's just as hard, right, to accomplish, right? So I think if the 10% long-term return of the S&P 500, that should be good enough for you overall. If it's not, thinking that you're going to improve upon that by timing the market, well, there's just very little evidence of people doing that repeatedly over many cycles, individuals, professionals alike.
Yeah. And it's funny you mentioned that question. A couple of people asked the question too. What happens if you miss the worst days and how big of an impact does that have? We've done some research on that at YCharts. We have some charts. So I'll make sure our team shares those out as well. And maybe we'll make sure to get those out to everybody as a follow-up. They're certainly interesting to look at. But I think the story remains the same, that you're not going to guess it right. And it's better to just stay in and be prepared ahead of time.
Absolutely.
Moving into the next section though. So where and how should you invest? One of the things that you brought up a little bit earlier on in our conversation was the Magnificent Seven. And I think one of the questions that we're hearing often from our clients is that their clients, the investors, are saying like, hey, how come we're not getting the same performance in my portfolio that I'm seeing when I look at these Magnificent Seven stocks? And maybe a quilt chart, a table like this is a good opportunity to talk through that question, as well as others, like why are we in some of these asset classes that aren't performing very well. But popular image, I'm curious to hear your thoughts on using this one for conversations too.
So this is a great one. You could see the colors jumping all around, right, from year to year. So that's the first point that should stand out to people, is that there's no consistency over time, right? Even if something does very well over a 10-year period that you're showing here, like growth stocks or the S&P, it's not doing it each and every year, right? So you still have to get through those other periods that are more difficult. So that alone should tell you diversification will help you stick through the inevitable times where there's going to be underperformance. But I think the bigger point here, Caleb, is that we don't know which of these is going to be the best performers in the future. We know what's done the best in the last 10 years. It's been large cap US growth, and everything else has not only trailed, but trailed by the enormous market. If we look at small caps, emerging markets, global developed equities, obviously bonds have gotten killed now with that rise in interest rates, and because interest rates were so low. But the next 10 years is not going to look like the last 10. Now, how will it look? We don't know. And so diversification is really an exercise, a twofold exercise in my point. One, it's an exercise in humility. So you have to admit that you don't know and say, I don't know, say it loudly. I don't know what the future is going to bring. Therefore, I have to have a little bit of everything, because then my portfolio is protected in case the future looks different than the past. If the future always looked the same as the past, it would be easy. We could just put everything in that Magnificent Seven and go home, right? But it's not that easy. The chance of that happening in the next 10 years, in my view, is pretty low. And therefore, you have to have a mix of these other things. Certainly, bonds are going to be better, as we'll talk about in a little bit in the next 10 years than they've been in the last 10, and we'll talk about the reasons why. But in terms of international or emerging markets, can't get too much worse than the last 10. Nobody wants to invest there. I get that, right? Because they've done so poorly. The story for the US is so strong today in terms of relative to everything else. But that's precisely why you might want to think about it, because they're so unloved. The relative valuations are significantly lower, right? So it's an exercise in humility, Caleb, and it's risk management. It's risk management because it's, as a fiduciary or even as an investor, if you're not an advisor, you're just an individual investor, you don't want to have the situation like we saw following 2000, where everyone crowded and jumped into what did best the last 10 years before that, which was large cap US growth stocks, technology stocks. And from 2000 to 2010, the exact opposite occurred, right? Where emerging markets did very well, small caps did very well, value stocks did very well, and growth stocks got killed, right? And will the next 10 years mirror that? I don't know. They don't have to mirror that for it to be a prudent idea to diversify. You can't do it after the fact. You have to do it now. You can't wait and say, well, I'll just see how it does. By that point, it's too late. You have to diversify in advance of that potential change in trend.
Couldn't agree more. Love the image as a way to defend those thoughts. That's talking about kind of where to invest, where to put your dollars. Shifting more to how to invest, right? So there's a very common debate, or I think a question that a lot of people have to ask for their clients if they have a lump sum, is whether it makes sense to invest that lump sum all at once or to dollar cost average over time. Now we're going to show both scenarios, and we're going to talk a little bit about each. But the first one we're looking at here kind of shows you the bad side of lump sum investing and why dollar cost averaging can make sense. So talk about this, and then we'll go into the rest of the debate as well.
Yeah. So the only time dollar cost averaging beats lump sum is when the market's going down, and we saw that in 2022. Then of course you're buying in at lower price points. You're going to beat that all-in-one investment on day one. And if you have this lump sum, there's a lot of different ways to think about it, and we'll talk about the odds in a little bit. But for a lot of people, it's really about regret minimization. So you just sold your business, or you inherited money, you got gifted money, any number of reasons, you got a big bonus. Should you invest it all at once? Should you dollar cost average? If the math of it will show on the next slide, but psychologically you have to understand yourself here, right? If you put it all in the market and it's right before the start of a bear market, you're going to be kicking yourself. You're going to say, gosh, I should have waited. I should have dollar cost average. Now, if you wait and dollar cost average everything, and you do it very slowly, and the market has a huge run up, you're going to say, gosh, I should have put it all in at once. So the answer is probably somewhere in between for most people, just to minimize that regret, where if the market goes down, they'll still have money to deploy at lower prices. And if the market goes up, at least they'll have something already invested, right? And what that breakdown between the two depends on your personality and how mad essentially you're going to be if it goes one way or another.
And Charlie, earlier you mentioned you're not a big casino guy. You don't like to go there because you lose money over time. If the odds were 74% in your favor, would you spend more time at the casino?
Sure, I'd be there right now. I wouldn't be, but they're not. And to the point here, dollar cost averaging is what most people do, right? Let's just say that, because you're putting money in your 401k or IRA every couple of weeks. That's when you're getting paid. So we're all doing that. If you have a job and you're putting money in your 401k, this is a separate kind of discussion. If you have this bonus, you have this extra piece of money, and what the odds suggest, and this shouldn't be that surprising, is if you spread it out, you're less likely to do better than just putting it all in at once. And what's the reason for that? Because the market usually goes up over a 12-month period of time, and if it's higher 12 months from now than it is today, it would have been better to put it all usually up front, unless there was a big decline in between. So 68% of the time, lump sum's going to beat dollar cost averages going back to 1928. So we have a big data set here. And if you say, well, that's not enough. Maybe I should wait, spread it out longer, 36 months. The longer you spread it out, the more likely you are to underperform simply putting it all in at once, because the more likely it is for the market to be higher. So lump sum's going to beat it 74% of the time. If we look at 5 years, you spread it out, it's going to be even higher, and so on and so forth. So that should dictate some of your decision making, particularly I would say if you're investing after a bear market, right? Or like the market's already down 20, 30, 40%. You probably have better odds at that point of doing a lump sum versus dollar cost averaging as opposed to any random time period. But for most people, if you don't want to dollar cost averaging, if you have that lump sum, dollar cost averaging is a market timing bet, right? You're essentially saying, I'm going to get a better average price. Right? You're not supposed to do that. But again, coming back to that psychological component, you have to understand who you are. And if you're going to be really kicking yourself for investing in the exact peak of the market, well, then leave a little bit to dollar cost average just in case it goes down, just in case at any point you should assume, this is what I tell people, when you're putting money to work, just assume it's the top, and then you'll feel better if it's not. But assume that's it, that's the exact top for that period of time, and that it goes down 6, 12 months, but 5 years from now, 10 years, 20 years from now, it's going to be higher.
Yeah, I think it's a good way to think of it. I think, there's the probably misleading statistic that people lean on too often, which is if you dollar cost average, your average price paid is always less than the average price over the time. But really what matters is the average price you paid and keeping that lower. And that's illustrated in this next chart, which can have such a huge impact over time with the compounding effects, right?
Yeah. I mean, just over long periods of time, if the market goes up, hopefully it will, and it always has over 20-year periods, it's unlikely that dollar cost averaging is going to outperform just buying and holding that index, right? Which is no different than saying some type of timing, even though you're not getting in and out, so to speak, even doing it just on a monthly basis. Time in the market is usually going to beat just spreading it out. So, and in this case, Caleb, right, your average price is going to be higher, right, than just buying all at once, because the market's going up, you're adding money. Well, that's a higher price point. It goes up again, higher price point. Yeah, there might be a bear market where you're able to buy average in at a lower price, but overall, it's going to, if the market's trending up, it's going to typically be a higher price. So again, know yourself, and if you're doing, if it doesn't have to be all or nothing. Like if you have a windfall, you have $1 million to invest, you don't have to put that whole million. You could do X dollars today and spread the rest out over some period of time, just so mentally it doesn't kill you if it goes. The goal is to be invested for a long period of time. And whatever could accomplish that goal, whatever can best get you there, I think is the right strategy, regardless of what is going to work out best in the long, because you don't know in advance, right? Like, yes, the odds are favorable to the lump sum, but we can see it's not all the time for sure, right? So there are certainly periods where dollar cost averaging can be better.
So not everybody's a net investor though, right? Some people are looking to actually draw income from their portfolios. And these charts, I think, try to illustrate how successful that income draw can be over time based on how much of your portfolio you're drawing down. Talk through this,
Yeah.
and then we'll get into some other data too, based on some further research you've done on this topic.
Great. Yeah. So the single biggest fear in retirement is running out of money. And it's a valid fear to have. Nobody wants to do it. And so figuring out first, before you think about withdrawal rates, figuring out trying to estimate what your expenses are going to be. It's obviously not an easy exercise to do, but that's a pretty good starting point. And then from there, figuring out what a withdrawal rate would kind of get close to that number, right? And with some margin of safety. And then you have to decide, well, do I want to cut back on some of those expenses? Do I maybe need to take more risk in order to have a higher withdrawal rate? Any number of scenarios. But as you can see here, the different withdrawal rate's going to have a pretty sizable impact on where you end up. And if you're looking at a 4% withdrawal rate, that's the standard. I think it's like the base case that most people use. Most of the time, as we'll show on the next slide, most of the time you do okay over time with that. It's viewed as more conservative, and obviously, if inflation is higher or the market doesn't do as well, you would rather have this lower withdrawal rate. And when you move up from there, even at 5%, most of the time that I've tested historically, you're not going to run out of money in almost any period. But when you start to get to 6, 7, 8%, and you unfortunate to retire during where a bear market starts early in your retirement, that could lead to you running out of money at the end of time. But that's a big difference, right? Talking about 4% versus 8%. I think for most people, they're not even thinking about it in percentages, right? They're thinking about dollars. How much do I need? And I think everyone's personal kind of inflation rate and expenses matters here very much. Some people spend less in retirement. Most people spend less in retirement than they even think they're going to. And, hopefully they'll spend the amount that brings them the most enjoyment, and they won't be forced to spend less. And that's kind of the goal here in trying to get to the right percentage where you can enjoy your retirement. You could do the things that you want to do. You could leave money to your heirs if you want to, and so on and so forth. But I don't believe in like a precise thing, one size fits all, because we're all so different. How could one number accomplish that? But if you're looking for like a conservative starting point, 4% is pretty good.
And talk about the odds here, or the I guess the difference between success or failure with the inflation adjusted part too.
Yeah, so I went back and looked at the I looked at all periods, but I specifically looked at the worst 20-year periods in history for a retiree. So let's say you retired right before the Great Depression, or right before the where the 20-year period after that, and the 20-year period where you had this very high inflation during the 1970s, and you had a difficult stock market. I looked at those scenarios and others. I also looked at the dot-com bubble and after that, but that actually wasn't as bad as these two, not even close. So even during these two periods, Caleb, I think it would surprise people if you started with that 50-50 portfolio of stocks and bonds, and you had a 4% withdrawal rule where you adjusted that dollar amount each year for inflation. So if inflation went up 3%, you would be allowed to withdraw 3% more than that initial amount. If it went down because of deflation, as it did briefly during the Depression, you would spend a little bit less. And what that showed over the 20-year period here is even during these worst possible scenarios, you still were left with a decent amount using that 4% rule. And I'm not showing it here, but even at 5%, you didn't run out of money. So I think that should be, first of all, comforting for people, that if you have the average retirement is 20 years today, if you have that 20-year period, a lot of bad things can go on in the interim. Don't get me wrong. Look at the start of the Depression there. You lost almost half of your portfolio, but if you stuck with it, you rebalanced. I'm assuming rebalancing every year or two here, back to that 50-50. You stuck with it over the next 20 years, you would have been okay taking out that 4%. That should be set, I think, a lot of people at ease when you test it against this. And really the only counter argument to that is people who say, well, what if it's worse than the Great Depression? And gosh, yes. What if it's worse? Then we have a lot of problems indeed.
You got to start from scratch with that conversation.
Correct. Yeah.
No, I mean, I think it's extremely compelling. I think probably the most difficult part would be seeing that balance start to decline and still making those withdrawals. But images like this and these stories, I'm sure can help create comfort.
And these are the worst possible scenarios. In over 90% of the scenarios at that 4% withdrawal rate, you have an ending balance higher than that starting balance. You actually have, you're not, and at the end of it, you're not even withdrawing from your initial principal, which is pretty amazing as well,
Yeah.
to show you that even with a 50-50 portfolio, which is somewhat conservative, you're actually not depleting any of that after a 20-year period by taking out 4% per year.
All right. Well, let's move into kind of more timely charts, current trends to watch, and talking about that 50-50 portfolio and probably the topic we've seen the most questions coming on
Oh yeah.
bonds. It's been tough for bonds. You've mentioned it several times, but let's go deeper on the topic.
Yeah, this is now by far the longest bond bear market in history. There's nothing even close now, and we're now over 3 years into this. So it started in the summer of 2020, if we're looking at that Bloomberg Ag Index, and now we're still around 17% below the peak from back then, and nothing comes close to this historically. And the reason for that is we never had yields do what they did over the past few years, which is go from an all time low where we had a 10-year treasury yield, it seems hard to believe, of 30 basis points. People are locking up 10-year money at 0.3% a few years ago. And today we have a 10-year pushing up at 5%. So, as we talked about back then, the bond market in 2020 was all risk, no reward. You had to be betting back then that interest rates were going to go negative to rationalize holding any position in bonds. That was my view back in 2020. Today, it's a very different story, right? At a 5% 10-year, we're moving up on this chart here on the right, which is kind of remarkable that in most things in the investing world, it's almost impossible to predict future returns. In terms of the stock market, throw it out, anything out the window. Anyone who tells you they can predict the next 7 years. The bond market, there's a 97% correlation between that starting yield and what the next 7 year return is going to be. And so today, if we have a 10-year yield around 5%, the odds are very, very high we're going to be in that 4.5 to 5.5% annualized return over the next 7 years. Now, the pushback's going to be, Charlie, well, what happens in the next 7 months? What if the 10-year goes to 6%? Yes, there's going to be more pain. And what the result of that is going to be, it's going to be even more compelling for bonds. So it's no different than a very bad bear market for the stock market. It's already down 30, 40%. This is the equivalent of, let's say the Great Depression decline for the stock market, if we're comparing it, right? For bonds, this is such an enormous decline. We've never seen anything like it. So what you would say to that is simply the risk reward has gotten even better. Yes. And so if you're thinking about the next 7 months and that's your only time frame, Caleb, don't think about investing in bonds because yields can go higher. You should be matching your time frame with the maturity. Go buy that 6-month treasury bill at 5.6%. That's fine. But if you have 7-year, 10-year time horizon as a bond investor, it pays now to take that duration risk. And the reason for that is you're likely to get a higher return. And when people ask you, well, I could still get a higher return on cash than I can on a 10-year bond. That's true. But the return on that cash we don't know what's going to be, right? It's a 3-month treasury bill. 3 months from now, again, the Fed is not likely to cut rates at their next few meetings. But if they start cutting rates next year, that could very well drive down that return. And you have to, in advance, start locking in the yield at some point. So depending on what your time frame is, that should really dictate how far out in terms of duration. And it's much better environment for the bond market and for bond investors today than what we had just a few years ago. It's like night and day. There's really no comparison.
So if the Fed is indeed going to pause or start to lower rates, is this a once in a, maybe not say once in a lifetime, but a very unique opportunity to buy bonds based on what we're looking at here?
It could be. It all depends on if they do what they did during the last 3 recessions, then yes, because the last 3 recessions in 2020 they cut rates to zero. Before that, in 2008 they cut rates to zero. Before that, in 2001, following that recession, they cut rates to 1%. So if they do any of that, yeah, for sure. But even if let's say they cut rates down to 3 or 2%, you're still going to be better off, right, in bonds. And but the broader point is we don't know what they're going to do. They could raise rates a few more times from here. We don't know any of that. You can't predict that. But as the yield on longer term bonds goes up, the probability that you're going to outperform cash over like the next X number of years, longer term, goes up, right? So in the early 1980s, when we're looking at double-digit yields, people said the same thing. Well, why should I buy a 10-year bond? Yeah, I could get a 3-month Treasury bill 13%. Well, the reason was because that wasn't going to last forever, perhaps. And today we're much lower than that. Could the 10-year go higher? Sure, it could, but you're much more insulated today, even if it does. So the yield going up now from, let's say, 5% to 6% is not the same as going from 0 to 1, because you have that cushion. You're going to have that coupon cushion. And I'm not saying it's going to be fun. You're still going to have some pain there, but it very quickly starts to offset itself when you have these very high yields. And all you have to do is look back to the 1980s, when you had very high double-digit yields and they went up 1%, and very quickly you were making so much on your money, you made back that price decline very quickly. So the math here has changed 100%, and what the Fed does, I would almost say, doesn't matter. But what, in terms of thinking about diversifying your portfolio and thinking about various possible outcomes, one of those possible outcomes today is that interest rates will be lower a few years from now. That wasn't really, to me, in 2020. Some people were talking about, oh, rates are going to go negative, we're going to join Europe and Japan. To me, that wasn't the real risk. The risk was going higher. Today, it's maybe not a huge risk, but there is a risk that perhaps yields will start to go down. If we know the Fed doesn't want to keep rates higher longer than they have to, and the minute they see economic weakness, in my mind, they're going to start cutting rates. How far they go with that, I think, will be dependent, of course, on what happens in terms of how bad it is.
So you mentioned rate cuts and when those might happen, right? The everybody's favorite recession predictor, the yield curve and the inversion of the yield curve. You got the 10-year to 3-month here. We talk about the 10s, 2s a lot, but give us an update and why have we been in this territory for so long?
Yeah, so it's been a year now. The yield curve actually first inverted, looking at 10s and 3-month, a year ago today. So we're exactly at a year here. This is now the third longest inversion we've seen in history, looking at consecutive days of an inverted yield curve. Number one was in the mid to late 1960s. Number two was in the early 1980s. And then you have today. If we go 4 more months of an inversion, will be the longest inversion ever. So who knows if we'll get there. But what a lot of people are saying, you probably heard them say it a lot in the last few months, is this is indicators broken. It's been inverted since last October, and we don't have a recession, so therefore it no longer works. And the funny thing is, they say that every single cycle, and the thing they forget every cycle is it takes time before that first inversion and before economic weakness then results. This is a very long leading indicator, as we talked about last year, and there's a lot of variability. So the average lead time is 24 months, but there's a huge variability in terms of, sometimes it's shorter than that, sometimes it's longer than that. It's not predictive whatsoever in terms of when that recession is going to be. But I think it's too early to say that it's totally invalid here. We're just at the 12-month period. If we saw a recession next year, it would be well within kind of the historical range. And that long and variable lag in terms of Fed hikes, we're really just starting to feel it today. If we look at the housing market, that's almost completely dead now, housing activity, and that's going to be a drag. If we look at the car market, it's almost no demand. 80% of people finance the purchase of a new vehicle. We got new car loans over 8%, right? Huge difference in terms of just the last year. You're looking at 5% a year ago, up to 8%. It's still rising. Look at credit card interest rates. We're at 21% now. All of these things taken together, Caleb, is likely to lead to what the Fed wanted, which is demand destruction. And yes, that's helped inflation come down, but I think it's still too early to say that this won't eventually, this just crazy sharp move higher in all of these rates won't lead to a period of economic weakness. It's just too early to say that.
All right, for time's sake, let's jump into the next couple of charts here. So moving away from rates and bonds a little bit and talking about the spread between large cap and small cap stocks. Small
Right.
cap's also been a rough go, huh?
So similar to the value growth, we have the lowest relative performance of small caps since January 2001. And on the right side, you're seeing the top 10 holdings in the S&P 500. Their weight is at a record high. So we're seeing just pretty extreme if you look historically in terms of cycles. Again, similar to that value growth. Nobody wants small caps today. I get it because they've had over a decade of underperformance, significant underperformance. The What people are saying additionally today, and they're not wrong about this, is that higher interest rates hurt smaller companies much more than bigger companies. So companies like Apple and Microsoft, they have these huge cash balances. They're actually benefiting from higher interest rates because their debt is long term and it's fixed interest rate, and they're earning more in their cash balances. Whereas these small companies, more of them have floating rate debt or they have debt coming due. They don't have a lot of cash on their balance sheet, they have more debt. And so it's put additional pressure on that. So that's the narrative, though, that explains this underperformance. And we don't know, has it gone too far in an extreme? And overall, like, do you want to have something in your portfolio other than just the largest companies? In the long run, the answer would suggest yes. And the best time to kind of want that other stuff is when it's done extremely poor, no different than value, because you're expecting some type of reversion to the mean at some point, but we don't know when. There's a lot we can go into, but I know we have some Q&A, so let's try to get to that.
All right, well let's go full circle with the last chart here and revisit something that we looked at I think a year ago, right? Which was what you call the upside of downside and the fact that there was a lot of pain, but usually that is followed by some nice gains.
Yeah, and it's good to see this. We didn't know a year ago. I just went back and looked at some of the slides from back then. It was all about fear and pessimism, and there was a lot of pessimism a year ago. And all we said at the time is that historically, a year later, after you have these sharp declines, things tend to improve. You can't say why or how it's going to happen, but it actually did happen once again here. And markets 21%. If you look at the Wilshire 5000, a broad index, 21% higher than where it was a year ago, which is just another reminder when things are bad. It's not to say that's going to be the lowest point that they're going to get. No one knows that, but if you're looking at years from now, I think the bigger point we were making it back then is like 10 years from now, most of the time things are much better. But even at a 1 year period, the odds start to become in your favor. And if we look at that differential versus all periods, the upside and downside is that if you have cash on the sidelines, if you're waiting for that lower prices, well, now you have it, right? If you have that money to deploy for the long run, there's no better time to do it than after a lot of pain and a lot of fear in the market. And in many respects, we're at a much different place in terms of sentiment today than we were a year ago. A few months ago, we were at the opposite extreme. We actually saw a lot of bullishness, and now it's after a little bit of a pullback, we're kind of leveled off here. But just shows you, right, Caleb, a lot can change in a year. A year from
Oh
now,
yeah,
I'm sure a lot will change once again.
we never run out of things to talk about when we get together every quarter or so.
No, it's just trimming it down so we could get to Q&A, which
That's
hopefully
right.
I haven't looked at the time here, but hopefully we have enough to answer a few
Yeah, I mean
questions.
we're coming right up on the top of the hour, but it's okay with you. We'll take a couple questions. We
Yes.
usually start the first one here that came through, and actually I think it came through a couple times. We spent a lot of time talking about the S&P 500. I think it's our favorite benchmark index for the stock market. In this table you use the Wilshire 5000. Also saw some mentions of like VTI, which is the total US market index. How do you think about those two, and why use the S&P 500 so often, and does it make sense to talk about these bigger indices sometimes?
Yeah, it does. And they're very correlated. I use the S&P just because we have more data in terms of looking back, historically over longer cycles. That's the only reason. But in terms of S&P versus VTI, the correlation is very, very, very strong. So it's, the large caps still dominate those indices. That's not to say the S&P is probably 80%. The 500 largest companies probably over 80% of that index. That's not to say that that other 20% doesn't matter. It's just it's overwhelmingly the same. And why you want to have a broader index versus the S&P? Well, it's that it would only if you only be on the belief that that ratio that we showed between small and large mean reverts over time, and there's cyclicality and there's some benefits to having smaller companies over long periods of time. And there's a debate about that, whether you need to have, let's say, extra small cap exposure. And my view is you don't necessarily need to have that based on the data, but there have been data that showed that small value does tend to lead to some type of a premium over long periods of time. And so perhaps that's an area for investors to consider. But the broader portfolio versus the S&P is simply to protect yourself in case those bigger stocks underperform. So we saw that from 2000 to 2010, where small caps had just enormous outperformance, large caps lagged. It's been a long time, right? It's been over a decade since that's been going on. So no one's thinking about that today, but that's exactly why you might want to think about it. And the simplest thing as an investor, and you can easily do it today with things like VTI, is to own everything, and then you don't have to kind of pick and choose what's going to be the best. You own everything, and if the future is better than today, if future is better today in terms of earnings, in terms of growth, in terms of human prosperity, then the market will probably be higher overall. But any individual company, as we've seen time and again, can go to zero and can underperform. And that's the biggest reason to diversify right there.
Yeah. And I think the other maybe piece, which you alluded to, but most of the information that we show with these long-term trends, the numbers are going to be fairly similar, probably within a percentage point or two, whether you're looking at the S&P 500 or one of these bigger indices. So I think that the trends hold up, but everything you said makes a lot of sense. This is kind of a big question, and probably one we could spend a whole webinar on, but maybe you can just touch on it for a couple minutes. As a lot of treasury, debt is going to be maturing, and they have to issue more, and they're going to be borrowing that money at much higher rates, based on where interest rates are right now. How concerned should we be when it comes to the bond market about that treasury issuance and maturing debt needing to be repurchased?
Yeah, it's a concern, but it's been happening already. Like, that was my big concern over the last few months. I've been tweeting about it, talking about it. You have 30. Unfortunately, back in 2020, we had the opportunity back then to take on long-term debt. We could have issued 30-year debt at less than 1%. There was some talk at the time of doing 50-year debt. I don't know what that would have had a yield, but that would have been the prudent thing and smart thing to do if we were going to borrow $4 trillion in a short period of time. We didn't do it. We did not do it. And so now the bill is coming due. So all of that short-term debt is maturing, and over half of the debt that we have will mature by the end of 2025, and a third this year alone has matured. So every single month, the interest expense on that debt goes higher. So now we're up to 900 billion. By the year end, we're probably going to be at $1 trillion. And then in the first quarter of next year, unless something changes, we're going to be probably looking at it being the largest line item in the federal budget, which creates a problem because then you have to borrow more money just to pay the interest on that money that you already owe, right? And it compounds and compounds. And yes, this could be, I'm not going to get into my views in terms of the policies and what we need to change there, because that's a whole nother webinar. But there's no way to predict, I would say, as a bond investor, how much more of an impact that's going to have. Like, in the last 4 months, we issued an enormous amount of debt. After that debt ceiling was lifted, right? You remember the so-called debt ceiling? Well, now we have $2 trillion more in debt in just the last 4 months. So the whole notion of a ceiling obviously was ridiculous. You can't have a ceiling when you're borrowing that much money. So we lifted that $2 trillion, and clearly that trying to sell that $2 trillion in a short period of time has been difficult, right? We just have less demand from overseas. Overseas yields are higher, right, as well. It's not just the U.S. Treasury yields that are going higher. So all around the world. You're seeing higher yields in developed markets, and then just in terms of the appetite for regular investors, it's just a lot to sell in a short period of time. So for sure, that is one of the reasons why we got to 5%. But going forward, is that going to lead to 6% or 7% because of that? Probably not, because there's so many other factors that are going on here, right? If inflation comes back down, if there's a growth scare, if there's a recession, now you're going to have that other outlets for demand, right? Where people are coming in and driving that yield back lower. So it's not just one thing. The issuance, I'm not dismissing it whatsoever. It is an issue, but it's not the only issue. And as a bond investor, I wouldn't really be thinking about that if you're a long-term bond investor, because as we showed, anything can happen in the next 6 months or the next year, but over the next 7 years, the odds are very, very high that you're going to get that 4.5 to 5.5%. But what happens in between, anyone's guess, right? But
Yeah.
there's no guarantee that it's going to go higher, significantly higher from here. That's just one possibility, right? It could go lower. Like this could
You're
be
going
the
to be
top
keeping a close
today.
eye on treasury auction stats and
For sure, yeah. But I don't think the average person has to be looking at
you got to be able to understand all those terms with tails and dealer buy
that.
down and everything. Last question we'll tackle because I know
Yes.
we're over time, but have seen it come through a couple of times. We talked about value versus growth. We talked about stocks and bonds. We talked about large cap, small cap. What about U.S. versus foreign or international stocks? How do you feel about that spread?
Same thing. I'm actually writing a piece on it right now. Hopefully, it'll be published in the next day or two. So where we are there in terms of the relationship is off the charts. So we haven't seen anything. We're over 2.5 standard deviations above kind of the average over the last 30, 40 years in terms of US versus MSCI World ex US. So the US has outperformed like we've never seen before, and it's done so for a longer period of time than we've ever seen before, which is just another way of saying it's stretched. Like it's very much stretched, even more than the growth and value, even more than the small cap, large cap. It's very much stretched, and there's a very much, I'd say, uniform view, and for good reason, right? There's always a good story when you had this type of run, uniform view that the US is the only place to be, and you want to continue to invest there. And it's what right? We know that magnificent seven. We've seen the tremendous growth there. But what I would say to people is investing outside the US today, don't do it because you're betting on a mean reversion. Do it because you're asking yourself, well, is that relationship likely to be even more stretched going forward, right? So the valuation expansion we've seen in U.S. large cap growth stocks has been enormous over the last 10 years. It's been a huge tailwind, right, for that relative performance. And there's been better fundamental growth, right? So don't get me wrong. It's not just valuation expansion. The U.S. earnings have grown far in excess of overseas earnings. But in order for that bet to continue to work, let's say the same as it has in the last century, it has to get even more relatively overvalued. And I don't think when something's already at a 2.5 times standard deviations above the mean, it's already that stretched in terms of the differential. And looking at U.S. valuations versus European valuations, when it's already at this historic divide, betting on a continued widening of that, I don't think is a good bet. So I think you do it because even if it stays where it is today, like as we saw that quilt chart, there's ups and downs. So there'll be years like last year where international outperformed, this year underperforms. Even if it goes back and forth and doesn't go anywhere, you'll still benefit from having that. And if there is mean reversion, if mean reversion isn't dead, then you'll benefit from that as well. So it wasn't that long ago, 2000 to 2010, when investors benefited tremendously from having exposure, international exposure. No, everyone's forgotten that, but it could, of course, happen again. And it doesn't even have to be that extreme for it to be beneficial to you in the future. So hopefully, investors will understand that that's only a probability, Caleb. There's no guarantee. And at a time where it feels like almost a stupid thing to do today to invest outside the US, given how strong the US has been. Well, that's precisely the time where you should start thinking about diversifying, because nobody's thinking about that possibility, and that means there's likely to be some opportunity. As to where exactly it's going to be, I don't know, or why it's going to happen. Why is there going to be better news? I don't know, right? So it's probably not a good idea to bet on one specific area outside the U.S. But I don't think the idea has changed that the U.S. might not always outperform all the time, which is basically why you might think about investing outside the U.S.
All right. Well, Charlie, looking forward to the piece. It sounds like you put a lot of thought into that. I'm excited to read that. Hopefully, everybody else checks that out too. But let's wrap up. Thank you again for taking the time today. A couple other just touch on the quick housekeeping items one more time. The deck will be sent out. Most of the charts in here are part of YCharts supercharged asset gathering deck, which we will make sure to make available and make sure that everyone knows where to find that. Those charts can be white labeled and you can use them however it makes sense to do so. So we'll get those resources out. We'll get the recording out. If you have any other questions, hit us up on Twitter, send us an email, do whatever it takes to get in touch with us.
X, Caleb, X.
X.
We can't call it Twitter anymore.
Thank you, Charlie. Formerly Twitter. All right. Well, Charlie, thank you so much again for the insights, for the time. Looking forward to doing this again soon.
Yeah. Awesome. Thanks for having me, and thanks everyone for joining. Always a pleasure.
All right. Take care. Bye, everybody.